Welcome to Module 4, where we'll be discussing interest rates, risk and reward, and fixed income securities. Let's start with risk and reward. In a theoretical world, the greater the risk, the greater the return. When we translate that into interest rates, the higher the interest rate, the higher the risk is. Or, looking at it in reverse, the higher the risks, the higher the interest rates. And interest rates, if we look at it, are a function of a couple of different things. First, we'll call this money supply, and time, and risk or credit. Now, when we look at the money supply, this is the basic law of supply and demand. That means that there's money available. When we say money available, that means banks have money, investors have money, the Federal Reserve is making money available to people. If there's a lot of money, then it will be a lot of money in the banking system. The rates will be lower because there's more money, supply of money, than there is for loans, which is demand. So think about that for a second. So if everybody's got cash and nobody wants to borrow, the rate comes down because there's no competitive pressure. It's not a shortage. It's a commodity. When there's less money in the banking system, rates will be higher because perhaps the banks will have lent out the money they have, and as a result, there is going to be the ability to charge more. And the same thing, if we look at this, if people have a need for money, that pushes rates up. So if a lot of people are borrowing, that is going to narrow the supply, and that's going to cause rates to go up. If people aren't borrowing, then rates will tend to drop. And that's what we've seen happen over the past few years. There's a ton of money in the banking system, but the demand isn't there. Now, we've all heard that the Fed has done different things. Well, the Fed can have an impact on short-term rates, okay, because that's what they can set long-term rates because they can be a lender. So what happens is when banks need to borrow, they can borrow from the Federal Reserve. So if they set a low enough a rate, that's what the short-term money will be because banks will be able to borrow for the Fed at that. And that's where they set the Fed funds rate, which is the rate that banks trade overnight money for their deposits at the Federal Reserve. So it sets the rate because you wouldn't go any higher because the Fed will lend at that rate. So that keeps them constrained and down. Now, the other things the Fed has done, and they have done this since 2008, they've engaged in what they've called quantitative easing. Okay, and this is where they're attempting to manipulate or manage the longer-term rates. The short-term rates the Fed can control by setting the Fed funds rate. Longer term, they don't set the rates, but what they can do is they can buy securities. So what they've been doing is quantitative easing, and they've been buying debt securities, and that has kept interest rates low. So we're starting with money supply. Just a quick summary. It's supply and demand. There's a lot of money in the system, the banking system, which includes commercial banks, investment banks, investment funds, pensions, mutual funds, your money market funds, all of that. If there's a lot of money out there, that is going to keep rates down. Rates will only go up when demand for loans go up and some of this money comes out of the banking system into loans. But right now, banks are sitting on plenty of money and they don't have enough opportunities to lend. That's the money supply. Next, time. The longer the time period, the higher the rate, because you're taking a risk by extending credit to someone over a period of time. So if you look at that, the further out I am, there's more risk, and I need to be compensated for that risk. Okay? And the risk is the ability to pay. We'll talk about that. It includes the inflation risk, that what will happen is that inflation rates will make the bond or that instrument worth less in the future. So you charge more interest to make up for that. There's something called a yield curve. And a yield curve, we're going to take a look at that in a second, shows interest rates by maturity. When we look at this link, when you're up on your own, you can click on this. If we look at what rates are today, June 3rd, we can see that the 10-year U.S. government is yielding 1.698%. The German 10-year is 0.074, and the Japanese 10-year is minus 0.098. So this is saying that investors are willing to buy U.S. government securities that yield almost 1.7% for 10 years. Okay, so that's telling us that there's not a lot of demand for money, but it's also that the growth rate and inflation rate are also anticipated to be very low. And it's almost nil in Germany, but when you look at Japan, it's actually negative. First time this has ever happened since money has been lent for thousands of years. And this is the first time, so there's really no history as to what is going to behave. Now, if we go over here on the Wall Street Journal site, and this is Wall Street Journal market data, we go to rates, what we can see is the different maturities of U.S. government securities. And as you can see that for, there's the 10-year. Let's just take a look at this 10-year and put it out there for what it, let's do a little full interactive chart here so that you can see it better. But you can see over the past year that we started out almost 2.5% last year. We saw it come down, and then we saw it come down precipitously so far this year. And what's happening is that across the world, central banks are reducing interest rates where the Fed is increasing interest rates. So what we have is we have other economies going so, central banks pushing rates so low that it's pushing money into the U.S., and that is pushing the interest rate down. So we've been at this 165, 17 range for a while, and if you can look at the trend, the simple moving average, you can say that it is on a downward slope. So that shows us the 10-year U.S. Treasury. If we go back and say that we want to look at 30-year money, okay, we bring up the 30-year, and you can see that the 30-year is just as low. Right now it's yielding 2.51%. So we're really incredibly low rates right now, which makes interest in borrowing very affordable for many companies. So we're in this historically low interest rate, and that should spur growth, but we're not seeing it as much because companies aren't making the investment. There's not as much need for cash. We're awash with cash. So it's making the opportunity that if you do want to make an investment, a company wants to invest, their interest rates can be very low and hence their rate of return. Keep that in mind when we move on to planning and we go into capital. Now, when we look at yield curve, we have what we'll call a normal behavior. In a normal behavior, shorter rates are lower than long-term rates, and you have the slope going up. Then you can be in a flat interest rate environment, and that's not much of a difference between short and long. And finally, we have the inverted, and that is when short-term rates are higher than long-term rates. That doesn't happen as much. But we look at this thing called yield curve and look at how it's sloped. Right now, we're almost in a flat yield curve, but it's also down to zero. So what we should see is we should see that normalizing up here. When we look at interest rates, so we started about with talking about money supply. Time interest rates change. but it's also a function of credit. Credit is a measurement of how one has performed in the past, and there's a lot more to credit besides how the individual or a company has handled their debt in the past, but the thing we call credit. And we're going to get into that momentarily. But the better the credit, the lower the rate, and the worse the credit, the higher the rate. So if you have a good credit, the rate's going to be lower because the risk is lower. The worse the credit, the higher the risk, and thus the higher rate. The quality of the credit also determines the availability of funds. Okay? Because there's only money available if you're going to get repaid. So it's not available for everyone. That's an important thing to note, and many treasurers of firms have found that out, is there's money out there, but you may not be able to access it. One of the things when we look at this is historically it's been assumed that U.S. government obligations are risk-free from a repayment perspective. Okay, that the government will always pay you the amount of that bond. So if you have a government bond for $100,000 on maturity, you will get paid that $100,000. There is no risk associated with that. The risk is with inflation. So you may get the $100,000, but if inflation is running very high, your money is going to be worth less. How does it become guaranteed? The government, the Federal Reserve, can simply print more money. And by printing more money, that will ensure that you will get your money. It may not necessarily be worth that. Now you say, why did I just listen to 10 minutes of this about interest rates? Well, why are we looking at this? It's important to see this. It's a precursor to understanding capital structure and leverage from the internal point of view of what the treasurer does and the CFO in determining optimal capital structure. Understand how banks and other lenders work. Then, understand things from an investor perspective. What is it that an investor is looking for in bonds, also known as fixed income investing? The other thing is to understand what it means to you as an individual. If you've already taken personal finance with me this summer or have taken it in the past, some of what we're covering might be a little repetitive, but it's a good refresher. So that's why we're looking at it. When you look at lending, and I'm going to look at it as if I'm a banker, that I'm going to lend money to somebody, we use what's called the 5 C's of credit. So if you are ever trained in commercial lending, you're going to learn everything there is about the 5 C's of lending. Some of them we are already working on, and you didn't even know it. The first is character. That when you're going to make a loan, you want to look at the individual that's running the company, What is the person? What is their history of success? What is their reputation in the community? Do they have good character? So if you have somebody that has been in business for 20, 30 years, has a reputation for being involved in the community, being a good corporate citizen, but also of repaying their debt, their ventures are good, they have good character. So that's the first thing a lender is going to look at, is the character. In the Rochester area, we have people who have opened up one restaurant and they run it for a year and then they don't pay the sales tax, they don't pay the bills, and they drive the corporate entity into bankruptcy. They open another one and they do the same thing. Other people have situations where they don't treat their employees right. They're always trying to cheat the customer. Those things are character. And if you're going to lend money, you want to understand the character of the individual. The next C, second C, is credit. And how have they handled obligations in the past? Now, what we're going to look at now, we're going to base it on personal credit, but commercial credit is the same way, the same situation. All credit activity is reported to a credit reporting agency, which tracks individual history. That can include TransUnion, Equifax, Experian. So you have somebody who tracks all of the credit in the U.S. individually and corporately. So if you borrow money from anybody, and that includes your cell phone, that may include certain apartment rentals, health insurance, any number of things that involves anything close to credit, that information is tracked and reported by a credit reporting agency. So that's the reporting agency. Now, over time, there's been behavioral and statistical models that have been developed that are predictive of future ability to pay back loans. These are mathematical, behavioral, and statistical models that have been predictive future ability to repay loans. Okay, you can bring it over. Okay, thank you.
Okay.
Are they eating outside?
Yes.
It was so cold.
Ah, that's what I said. I said they're going to be back. Sorry.
Okay. These models are used by most lenders, and that determines who gets credit, who gets insurance, and what price they will pay for it. The most commonly used score is one computed by Fair Isaac, also called FICO. And the scores range from 300 to 850. They're mathematical scores, 300 being the worst, 850 being the highest. And you can go to this right now and you can look at the site. And I encourage you to go look at the site, play with it. I encourage you, if you have not run your own credit report, do so now. We're also going to take a look at this video which explains what FICO is. Let's look at that for a moment. I think that gives you a little sense of what it is and how it's used. Many things go into this score, this mathematical score, your FICO. And it includes payment history, which is the biggest piece of the pie. Now, these are estimates that people have made. Fair Isaacs hasn't disclosed that, but this is what it's in thought to be. Payment history. We're going to go through each one of these. Is the biggest, followed by amounts owed, followed by the length of credit history, followed by new credit, and then the types of credit. So it's a combination of a number of different things. The first one and the largest is payment history. And what that essentially does, it goes through every account that you have credit with, and it indicates, have you made your payments on time? And if you have, then that's clean, no negatives there. It measures, though, when you're 30 days late, 60 days late, or 90 days late. So if you get your bill on, say, the first of the month, and they give you to the 20th to pay it, it's not going to be late until it's 30 days past the due date. Okay? So that would be measured by times late 30, you're 60, 90. So you'll see it reported in credit reports, and the FICO score measures how many times you've been late: 30 days, 60 days, 90 days. And they look at that to get a sense of how you are paying. And these statistical and behavioral models would say that if you have a habit of paying late consistently, and that's when you look in. If it's one, you're all right. But if you've got this happening constantly, that's an indicator to the lender that you don't always pay your bills on time. That indicates greater risk. And they look at it relative to the numbers of accounts. If you have 50 accounts and you were once late 30 days, that's going to have an impact, but it's not as bad as having 10 accounts, all of them with 10. One can be rationalized as a mistake or an error, but the higher the number, the worse it is. Okay, and it moves up very quickly because that's the key part of that model. Adverse public record, that means you have collections. Okay, that somebody has filed a lien, a judgment, is trying to recover money for you. It's in collections. Those are reported that way. They also look at times past due. So when you look at all of these things, this is about 35% of what goes in. Now, this is true. This is from a personal perspective, but businesses have the same thing. So this is the biggest thing. So times late, how big is it relative to that? And the time since past due. Amounts owed. This sort of makes sense. How much do you owe on your accounts all over? Okay, how much do you owe? The bigger the amount, the greater the risk. Now, income does not go into the credit score. Okay, that's what a lender will gather when we look at what is the ability of the borrower to repay. That this is the amount owed on accounts. They look at it by type of account. They look at a mortgage account differently than a credit card, which is looked at differently than a student loan, which is looked at differently than a car loan. They're each looked at individually. If you're looking at a mortgage loan or a student loan, those are paid back over a long period of time. And you look at credit cards, which have a shorter period of time along with credit. So they look at it by specific account. And sometimes if you actually have a lack of a balance, that can hurt you too. So if all you have is a mortgage, you don't have any credit cards, you don't have anything else, that can be negative. They also look at number of accounts with balances. So if you have 10 credit cards and they're all in use, that's not always as good as 10 credit cards with some smaller balance or no balance. Now, the next one is really a freebie, and what they look at is the proportion of credit lines used, meaning they look at how much do you have outstanding versus the amount that they've given you, what's your credit limit. So if you have $1,000 outstanding and you have a $2,000 credit limit, you are 50% used. If you have that same $1,000 and you have a $5,000 credit limit, that's only 20% used. Once you go over 50%, that's bad. Higher that percentage, that is going to negatively impact your score. So now you say, well, okay, that makes sense. If you're all the way up to the top, that means you may be spending more than you can repay or more than you're earning. And it's telling a lender that perhaps you don't have any more room to wiggle. Now, what I encourage many people to do, and I would encourage it with you as a younger person, to make sure you do have a credit card. I make sure your credit card is tied to your checking account so there's no overdraft fees, because overdraft fees are very costly and embarrassing because your check or other transaction could be returned. So what you want to do is if you have a $500 limit and you've had the account for a while, go ask for more. And you want to keep doing that until you get up to a comfortable amount. I'd say you should have at least $5,000. That doesn't mean you need to use it. It's just going to keep that proportion very low. If you keep if your limit is only $500 and you charge gas twice a month, you're going to have that balance. Even though you may pay it off, it's at a point in time. So you want to make sure you keep this proportion as low as possible. The other thing they'll look at is the proportion of installment loans, which generally car loans, boat loans. Think about this from a risk. If I've just got a car loan and there's 60 months of payments to be made, that's a lot more risk to someone than if there are 3 payments left. There's less risk. So the model looks at all these things and puts them together. Length of credit history. How long have you had credit? How long have these accounts been opened up? They look at them by specific type of account. They look at them the time since the last activity. So since I'm old, my credit report goes back many years. Okay? Yours is relatively new. So the longer the history and your history of paying on time, that becomes more predictive of how I will handle my debts going forward. Since you may not have had credit established, there's not a track record. So that could reduce your credit score. The other thing they look at is new credit. Number of recently opened accounts, the proportion of accounts that were recently opened, what type of accounts, how many credit inquiries have been made on your account. Now, if you're looking for a car, you may get 5 inquiries, but they put them together because they know you're looking for one. Time since recent openings by type of account. So look at new credit. Next one is really one that a lot of people don't think of is, do you have credit? Do you have a variety of credit? Credit cards, store credit cards, installment loans, mortgage, consumer finance. They are looking for individuals to have a variety because that'll give us how you behave in different ones. So that's credit. What we talked about so far is personal credit, that these behavioral and statistical models have been developed that are predictive of future ability to pay back loans. As we said, most lenders use these to determine who gets credit, what the price is, who gets insurance, etc. And as a reminder, Fair Isaacs is the most common personal model and is called FICO, as we've been talking about. Now, various lenders use different models based on what they're looking for and the type of credit and what they're looking for. So now we have on the business side, for small business, we have Dun & Bradstreet, which does a review. There's a Global Credit Services, which is another provider, runs ClearPath Insights. These are two of the ratings, two of the folks that rate small business, small to medium-sized business. Now, a lot of small business is based on the credit of the individuals, the owners of the business. Even though it's a corporation and there's limited liability, you'll find most lenders are going to make the decision based on the credit of the individual that owns the company. So I think you have that. And a lot of for small business, lenders do the underwriting. They look at the financial statements. They gather what's needed. But these are the two most common ones, Dun & Bradstreet and Global Credit Services, ClearPath Insights. ClearPath Insights is very much like a FICO credit score. And that's how loans to small and micro businesses are made. When you get into much larger credits, they're rated, okay? And they are rated by, we'll call them the big 3 rating agencies. Those are Standard & Poor's, Moody's, and Fitch. So these are groups, companies, that look at the underlying credit, and they have developed their own models of evaluating them. So they're looking at the performance of the company historically. They're looking at what the future is like. So these 3 rating agencies will do a couple things. One, they rate the bonds. And a rating, it starts, and this is common for most of them, they start with AAA, which is the very, very best. And it goes all the way down to D, defaulting on these debt obligations. So you can see the rated AAA all the way down to D. So AAA, AA minus, A minus, plus and minus. So there's a lot of degrading in there that you can really get different views of it. And of course, pricing goes along with it. The better the quality of the credit, the higher the rating, the lower the price. Okay, so this is just a matrix for you to look at. Here's the comparable when you look at Moody's, S&P, and Fitch. They all have a AAA. Moody's use small, they use big. But I think what's important to look at are these first four categories. This is what we call investment grade. And these are securities that can be used for certain pension plans, that can be invested by endowments and others. So that means prime, high grade, medium, low. These are all your good investment quality. There's always risk, okay? But in these, the risk is relatively low. Then when you go below this, this is often called high yield or junk, okay? And a lot of companies are in this range right here. They're non-investment grade. They're all BB in the case of this, S&P and Fitch. They're BBs, and this one is a BA. So these are your non-investment, but these are the ones that, yeah, they're pretty solid. They may be newer companies. They may have a little bit more risk, but they're not speculative at all. And what you find is that when they're investment grade, the yield is going to be less. As soon as you move over, and I don't like the word junk, it's really, it's higher yield. Okay, the junk is really down here in these are the non-rated. When we look at governments and we look at obligations of governments, there's the first one is sovereign debt. That's the obligations of a country. Okay, so U.S. debt is rated. Those are also rated by the agency. Okay, the Fitch, the Moody's, the S&P. In the U.S., there are treasury obligations. These are the direct obligations of the U.S. government. T-bills, T-notes, T-bonds. We looked at what they were, 1.65. Then there's government agencies. And these are not direct obligations of the government. However, that in case of certain evidence of default, the government will step in. That's Fannie Mae, Sallie Mae, Freddie Mac, etc. So this is sovereign debt, obligations of a country. Then we move into state and local governments, oftentimes referred to as munis. These are generally rated, okay, and they're rated by agencies. The small ones aren't. We call these are the fire departments and very small municipalities. Some of them are what we'll call full faith and credit, meaning that it's the full taxing authority that is behind the bonds, okay, or the debt that's issued by that municipality. They're called full faith and credit. Then there's those that have projects, sewer system, water system, fire trucks, or have a dedicated source of repayment. So they may have a bond that is secured by sales tax payments. There could be some that are by the tobacco settlement payments, which come in over time. So those are not full faith and credit. They refer to a specific source of money to repay. And there's, again, a little bit more risk. Now, states are more solid than our municipalities. We've saw Detroit go into bankruptcy. We've seen a number of smaller ones. We've seen counties. We haven't seen any state default yet. Now, when we look at the debt ratings of the different countries, we can see that the Moody's has rated, the U.S. Moody's and Fitch have rated us AAA. But if you notice, S&P downgraded us. They downgraded us a couple years ago when the Congress didn't pass a budget and didn't extend the debt ceiling. So you can see that in S&P's rating, Britain, Germany, Luxembourg are all rated higher than the U.S. And Britain and Germany and Luxembourg are rated higher by Moody's and Fitch, just the same level as us. Okay, so you can see this as to which ones are really high risk. The investment grade ones are the dark blues, so the high, good ones. And as you can tell, when you move down here to some of the others, and then you get into Portugal, Italy, Greece, okay, Spain, they're called the pigs, okay? That would be Portugal, Italy, Greece, and Spain. These are the ones that are less good. But it varies. Right now, we have, I think you can see Russia. Is Russia here? No, it's not. Russia is actually rated higher right now than Greece. So that's an interesting. So that's how the commercial and corporate and municipal and sovereign debt are rated. Very similar to the person. It's about the ability to repay. It's just how they determine their ability to repay can change and can be different. It's credit. Okay? So that is a very important thing. You have a record. Businesses have a record. How have you behaved? Are payments made on time? Okay? Because that is going to help you determine that if I am going to extend credit to you, do I want to based on your behavior? If you have a low credit score that's giving me more risk, I may not even want to lend to you. Okay? And if I do, I'm going to more. The third C. This one, we've been spending the first 3 weeks of class talking about this. Cash flow. You repay debt by cash flow. As a lender, you're looking at cash flow. And that's the capacity to be able to repay the debt. You got to see what's out there. So everything we've been talking about is this third C of credit, the cash flow. Lenders need to understand the cash flow. But if I'm trying to sell a banker, if I'm the CFO, the treasurer, and I'm trying to sell a banker, I have to provide all of this information so I can convince them to lend me money. So that looks at sources and types of income, and there's different guidelines. And the guidelines vary. For an individual perspective, we always look at it that housing costs should be 30% of income or less. Total debt should not exceed 35 to 40%. We have guidelines on the commercial side. So the third C is cash flow. You already are getting the importance of that, how you can evaluate the company, and that's how it fits into credit and that. When we look at cash flow from a commercial guidelines, it depends on the type of loan, which comes back to your cash conversion cycle. Okay? Is it a working capital loan? Is it a loan that we need for seasonality? Is it a line of credit to get us through that period of conversion? Operating cash flow, debt in the range of 125 to 175. So that's the cash flow. The fourth C of credit is collateral. If you can't make the payments from your cash flow, how will the lender get repaid? Now, as a lender, I want to be repaid. I don't want to take something back. So I'm always looking for a second way out. As a lender, my goal is really to get paid back from the cash flow of the company. But I need to have another out. In fact, I like to have 3 outs as a lender. So the first one is collateral. What property or equipment can be pledged to make the loan better than in case? So the greater the collateral, the better. So if you want a mortgage of $50,000 and the building is worth 10, you won't get a mortgage. But if you want a mortgage of 50 and the building is worth 150, that's good because you have a lot of collateral. So if you didn't pay on that $50,000 loan, we could sell the property and have enough back. And the type of collateral often drives the price because there's time and money to convert. If you pledge your car, I have to go pick up that car, sell it, and that makes that collateral more risky. If I am sitting on a savings account balance, it's much easier. So we look at the type of collateral and then the value of collateral, which we talked about. What is it worth? So collateral is the fourth C. So if I'm making a loan, I want to make sure the character is good, the credit is good, the cash flow is good. Make sure I have a second or a third way out. On the collateral, it can be a physical asset, it could be a business, it can also be the guarantor of someone else. So if I'm running my own business, which I do, I have to guarantee the debts of the company. So not only does I have a real estate business, not only does the bank look for my cash flow from operations to repay the debt, they look at the value of the property they have the mortgage on, and in the event I can't pay it from what I'm getting from my rental income, and they sell it and they can't get it back, they have my personal guarantee and my personal assets at risk to do that. So they're very well secured. You probably would find that credit problems happen when you don't follow these 5 steps. The 5th C is common sense. Does the transaction make sense? Is the story believable? Okay? And this is a real tough one because sometimes a deal just isn't right. Okay? It's not practical. There's not enough experience of the individual running it. The location may not be the best location. If somebody said, I want to build a 20-story office building in Geneseo, New York, you'd say, no. There's not it doesn't make sense. Okay? There's no logic behind it because Geneseo, New York does not need this huge office type. Is the story believable? Yeah, the price is reasonable for what they want to change. Is their business plan reasonable and have common sense? So if they're going to open up a yarn store, okay, and they're going to hope to get 5,000 customers a year, and you're based in Geneseo, New York, guess what? There's not 5,000 people who are going to buy yarn from you in Geneseo. That's what common sense is. So those are the 5 C's of credit. Number 1, character. Number 2, credit. Number 3, cash flow. Number 4, collateral. And number 5, common sense. The next thing when we look at commercial loans, there are a couple of different loan types. And the first one is a term loan, and it's for a set period of time, and it has regular repayments, and it has a maturity as a set date. It can be used for equipment and other longer-lived assets. Now, when it is secured by a piece of property, it is called a mortgage. Okay, there is a term loan is when it repays generally in monthly installments. And you try to match the term of the loan with the life of the asset so that they move concurrently. Then we have lines of credit. These are issued by a bank. Most of the time, they're used for working capital, short-term needs, and have a 30-day out-of-debt payment. Then there is a revolving line of credit, and this is available for a set period of time. Most of them are formula-based. So it'll say, okay, we will advance you a specific percentage of eligible receivables and inventory. That might be receivables that are all current, meaning that they all are due within 30 days. And a bank will lend a percentage of that, and for collateral, the bank takes that asset. Line of credit is often a fixed dollar amount that the company has available and isn't necessarily tied to a specific inventory or receivable. Next thing is we call them they're letters of credit, and these are used to finance trade. They facilitate trade. Like if you are a company, just say headquartered in Geneseo, and doing business in Shanghai, China, the buyer or seller of those goods, depending on whether you're importing or exporting, doesn't know you. So what happens is there's a substitute, or you don't know them, there's a substitution of bank credit. So the credit becomes to banks. And these letters of credit are issued by banks, and they literally put the bank in your place. Okay? So what'll happen is we might have in Geneseo Community Bank or Five Star Bank or Bank of Castile. So they normally need to go through another bank, okay, to get theirs accepted so that the client in China can handle it. So what you really have is these are done by the big banks are the big issuers of those. They're to facilitate trade. Then there's another one, it's a standby letter of credit, and that is a guarantee of performance or repayment. So those are letters of credit in a nutshell. Pricing varies on the risk, structure, collateral, time period, guarantees. Some of it is publicly traded, so that there's always a bid-ask and a bid-ask spread. Some of them are private, fixed versus variable. Some interest rates are fixed over the term, some are variable. Some are based on pricing indices, such as the used to be the prime rate. Now the prime rate doesn't really mean anything because it hasn't changed in years. The Fed funds rate. A more common day one is I'll give you, there's three right now. There's a 30-day LIBOR, London Interbank Offered Rate, 90-day, but more commonly in the U.S., it's called, you look at the comparable maturity of treasuries, and it's called a spread treasury. So if we saw earlier that the treasury, 10-year treasury was 165, say, and your rate might be 200 basis points over treasury. So in that case, it would be 3.65. So it's generally, when it's variable today, it's tied to treasuries so that a bank can make money on it. LIBOR is also more common, but there's been some fraud there. Fed funds rate, not so much, because banks don't fund that way anymore. Rates would come back as to how the bank funded itself, but that's a more advanced topic which we don't need to get into today. And the prime rate has just sort of gone away. Now, the other things that go into loans that become very important to a company and to a municipality is the frequency of financial statements and deadlines. When do you need to provide where did that go? Okay, there you go. Frequency of financial deadlines. Does have to be audited, unaudited. A lot of them have a certain debt or free cash flow, interest rate coverage ratios, EBITDAs, free cash flow. Now, you might have seen that already. So what will happen, where you have calculated the interest coverage ratio, the bank may say, okay, we'll give you this loan, but you must maintain this interest rate coverage, or you can't exceed your leverage of, or free cash flow must be this. And that becomes important because if those are not met, that would be a technical default. So banks are oftentimes using the ratios that you looked at last week and calculated. That's how they determine if a loan is having problems. Okay. Some of them will limit dividends or stock buybacks. Some of you have seen stock buybacks. You've seen dividends in the cash flow statement. Remember, the bank is trying to bank or lender is trying to protect themselves to get repaid. Okay. Limit capital expenditures and acquisitions. You've seen some of your companies have spent a lot of money, but banks will put a limit on that so that they're making sure they can get repaid. Those are loans. Now we have, at the same time, loans are from a document, are loans, and they go through a lender. That lender can be a commercial bank, alternative lender, brokerage firm, pension fund, any number of them. But then there are bonds. These are direct obligations that are issued by the company to investors. The term generally will be an original term and remaining. So if it's a 20-year bond and it's issued today, that bond would not be maturing, if you will, until 2036, because it's a 20-year bond issued today. That's the original. But if that same bond was issued in 2006, its maturity is going to be 2026. Okay? Interest is often paid quarterly or semi-annually. Principal often paid on maturity. Okay? Cash flow from bonds is interest payments and principal repayment. So you're always looking at what's the future cash flow, and you're using present value models to bring them back. Check that next piece out on that. On issuance, any bond is assumed that the price and yield are market. Okay? Which means that a bond has a market risk for the interest rates and has credit risk for repayment. The company records the debt on its books and generally doesn't adjust the principal amount. There's certain exceptions. We don't need to worry about them. And bonds are sold in the market. You can check this link out at your convenience. And Bonds 101 give you the process of issuing them. I'd encourage you both to look at that. Now, if a bond is publicly traded, the price of the bond is going to change based on market demand for debt at that credit level and the remaining maturity and credit characteristics. Okay, so that moves inversely. The price of the bond moves inversely to yield. So in the case that the bond interest rates go up, the value of the bond goes down, and vice versa. Because the overall cash flow doesn't change, it's just the value of that cash flow. So that concludes our lecture on interest rates, credit, loans, and bonds.